Good morning, everyone. Welcome to this update for global stocks and commodities for the 14th of July. Not a lot has changed since last week, except the US market has now advanced beyond 3,000 points and set new all-time highs, which seems to confound a lot of people. But as I've been saying now for quite a few years, you need to focus more on the price action and give less attention, I guess, to the fundamentals, because the fundamentals don't seem to mean a lot these days. So let's jump into it. The global uptrend remains in force pretty much everywhere. The China market is still struggling a little to get momentum, but there's pretty good momentum elsewhere. And once again, we're continuing to see that the forecasters are still pretty disastrously wrong in what they've been saying over the last couple of years. There'll be the normal stock and commodity trend update, and portfolio analysts last week, I continued the focus on some of the outstanding gains that we've had for Australian small caps, and last week was as good as any, with some terrific performances. And for those of you that are in portfolio analyst, you'd know that we've got a bit of a portfolio building on stocks that I think have the potential to go up by a very, very substantial amount, by 5 or 10 times their current value over the next perhaps 2 to 3 or 4 years. And certainly those stocks are delivering. So very pleased with that. If anyone hasn't had the opportunity to take that $1 2-week trial in Portfolio Analyst, then it is still available. So American stocks ended up gaining 1.7% for the week, 50 points. This is now the longest economic expansion in US history, but it's been by far the slowest, and that's why it has gone on for as long as it has, and why it's confounded so many people who seem to feel that just because it's 10 or 11 years old that it's got to end, and that's of course not necessarily the case at all. And investors who've been working off all the normal sort of norms, and really this conversation has been going on since the US expansion was about 7 or 8 years old, and now it's 11 years old. And so people that have been working off those norms, expecting it to come to an end just because of age, have been left very much behind. For the last couple of years, forecasters have been saying that there's only 1 or 2% left in the stock market, and we're going to go into a bear market. And of course, that hasn't been the case. The S&P has continued to advance from somewhere around the low 2,000 point area, and now we're just over 3,000 points. And the S&P is up 18% this week. So that's this year. So that's the facts of the matter. And again, just a very graphic display that you need to just focus on the price action and not worry too much about what everybody is telling you as to what should happen. Earnings season has now just started. The first couple of preliminary reports came through, and they beat expectations, and it really gets underway in earnest this week coming with the US banks. And there's no reason to suspect that the outcome's going to be any different to what we've seen over the last few years. So I think that'll probably just reinforce the fact that the American market is not overvalued, and from a valuation point of view, there's no reason why it can't continue to rise. The US dollar was down slightly on the week, but is still on trend support, which it did breach a few weeks ago, but then recovered. Inflation readings are picking up a little bit in the US, which it's only one data point, so we'll need to see if that follows through. But that's certainly confused markets to a degree. Now let's just take a look at the S&P. So I'm going to start with the monthly chart, which really shows graphically what the last 6 to 10 months has been about. You can see we had that big dip that occurred here in December, and then from then it's just been a pretty much a straight up recovery. We did get a down market in May, but we're now back at all-time highs and closed at 3,013 points. So you can see that really that trend got a little bit wobbly last year, and that was really about the Fed talking about continuing to raise rates. And as soon as they backed off that, you can see the response from the market. Just switching now to a daily chart, you can see just how robustly the market finished last week. It finished right on its all-time highs, so the buying went all the way into the close on Friday night. So that's very impressive. If you look at the US dollar, you can see we had a very, very clear and obvious uptrending channel. We breached that in June when there was talk about the Fed actually cutting rates, but then common sense prevailed. The market rebounded quite quickly, and it'll probably just consolidate around this area for a period of time. The Australian dollar has really just been moving with the US dollar, so we're still just hanging around this 70-cent mark. Let's take a look at the ASX 200. And we're continuing to advance as well, but we're right tucked up now close to the all-time highs that were formed in 2007. And from a valuation point of view, and given the strength of the Australian economy, which is not strong at all, it would be difficult to envisage this market continuing this trend for too much longer. But as I've been saying over the last few weeks, it's really a case of there's nowhere else for money to go. Certainly in Australia, not in the property market, certainly not in fixed interest or bonds, and so stocks are going up, or the larger stocks are going up more than they otherwise would. So just to confirm on the Australian market, our dollar finished at 70.2, and our index was ended up. I'm sorry, that should say. Just let me check that. Yes, that's correct. So we were down 55 points on the week. There is really this nowhere else to go syndrome, I guess, in the Australian market. But that, to me, is not a reason to move into stocks that are probably fairly low growth, given all things considered. The stocks that are focused mainly on Australia. So my focus over the last several years and where the real action has been is in the small and mid-cap growth stocks, and they've certainly been paying very handsome dividends of late. Moving to precious metals, gold advanced $16 to $14.16, and the consolidation there above 1400 is still in progress, despite the fact that a lot of fear about the global trade war, about what's happening with China, about things going on in the Middle East, North Korea, all those things have subsided, yet gold has certainly held its place. And I think that's because, people are looking at the fact that maybe the central banks are running out of ammunition and don't have anywhere else much to go at the moment. So there's certainly a move back into gold and gold equities. That meant that the Australian dollar gold price has still been able to retain its footing above $2,000 an ounce, so finished at 2017. Now, when you look at GDX, it's still doing better than the metal, and it hit its highest level in almost 3 years, 2016, which is when the last run in gold and gold stocks expired. So let's go and look at the gold chart now. There is gold on a weekly basis, so you can see very, very clearly that we've broken out, had a terrific run up to 1440, pulled back to the breakout, which is all pretty normal price action, and then another pretty handy week last week to finish at 1416. So a little bit of consolidation going on there, and if we switch over to GDX, you can see there that GDX has also been able to really reinforce the breakout. Up until last week, we didn't really have that situation, but now it has broken out, and it's looking pretty strong. So you've got to go back all the way back here to September of 2016 when the gold market had peaked and started to roll over. That were at these levels. So things looking very good for gold and gold stocks. Other commodities, copper was steady at 268, really just moving around slightly with the currency, but there's a pretty subdued outlook for industrial metals around the world. Crude oil did spike up quite strongly. A little bit of currency help, but mainly about lower inventory data. So that sort of goes against the bit of the flow of economic data elsewhere. There's the copper chart, hasn't really changed much since late May, and the crude oil chart showing a very strong rebound from the low $50 area up to 60. So just to wrap it up, the important thing is to watch the price action, not the forecasters. I think pretty much ignore the forecasters about where they're saying things should go. Slowing global growth is a bit of a concern, but markets just really have no alternative but to equities. And I think dips can be bought with a degree of confidence, but I would certainly wait for the dips, given where markets are at the moment, very much towards overbought. And it's really important to have a pretty clear game plan about what you're doing. It's a bit like a chess game at the moment. You need to think a few moves ahead and make sure that if you do start to accumulate stocks at this level, that you're pretty clear about what your expectations might be in the short and medium term. Portfolio Analyst upcoming is just going to retain a continued focus on high growth Australian small caps, the 10 potential 10 baggers as I've been calling them, and they're really starting to look very good, and also of course on other established growth stocks that are perhaps already $1 billion or $2 or $3 billion and have had a really strong run, but if you accumulate them on dips, you can still do pretty well out of trading those sort of stocks as well. So that's it for this week. There's my contact details for anyone who's not a member of any of the services, and there will probably not be a video next weekend, given where I am currently traveling. And I'll be, if that's the case, then I'll be back with you in 2 weeks' time. That's it for this week. Cheers.